So there is a big upcycle right now in real estate, and people want better properties, bigger properties, and they are chasing, from a residential standpoint, they want to enter into, the most premium properties. It's called plotted land development. That's the biggest asset class that is coming to the market right now.
Is it?
Yeah. Especially in Bangalore and Chennai, where, near the airport side, airport is like 2 hours away from the city. Near airport, there are a lot of construction happening. There are certain platforms in the market also right now coming specifically for retail investors who are, asking for 1 lakh or 10 lakh rupee checks, where you can do construction-based financing of plotted land purchase and then, flip them around. If you are regulated, there are also certain rules around how you can do advertising of your products and, your services.
Hello and welcome to Mint Money Talks. This is Neil Borate. I'm the personal finance editor at Mint, and joining me today is Yash Roongta of Alt Investor. And we're going to be discussing the one asset class that has been a perpetual sort of zone of attraction for Indian investors, which is real estate. It has historically had extremely high rates of return. Even now, I think the return rates are pretty high. So before we get into the details with Yash, I will just give a short background of what I have seen with real estate investing over the past 6-7 years. When I joined Mint in 2019, this decade-old real estate cycle had sort of begun playing out in its destruction, in the sense that a lot of builder defaults were happening. And this was hitting the organized sector and the unorganized sector. So there were funds, organized funds like Aditya Birla Real Estate Fund, which we documented, which was seeing defaults. And there was unorganized lending, like direct checks to builders. And those builders had begun defaulting. So there was this famous case of D.S. Kulkarni, a big builder in Pune, who had defaulted in 2016 only. And everything moves in cycles. So post that, a new cycle started in real estate, new funds were launched, and we're probably in the early stages of this new cycle. But Yash, what has your experience been, and what does the market look like now?
See, during the pandemic, there was a lot of inventory that was getting unsold because developers already had done a lot of projects and businesses took a hit, so they were not getting that enough cash flow to buy out properties. But as soon as the pandemic finished, there was this big upcycle. You might have heard news of, Gurgaon flats, selling for 65-70 crores, 95,000 rupees per square feet kind of rates, which are just astronomical. Given the locality, or given, if you go out of that particular compound in that road, you'll see it's nothing. So there is a big upcycle right now in real estate, and people want better properties, bigger properties, and they are chasing, from a residential standpoint, they want to enter into, the most premium properties as well. From an investment point of view, getting financing for these kind of projects has never been easier. There are multiple avenues right now available to developers. So if I have to give examples or break down these examples, let's say one is, when the developer has decided that they will acquire a land for this property. It might be just a barren land, which they will, get the electricity sorted, the water supply sorted. It's called plotted land development. That's the biggest asset class that is coming to the market right now.
Is it?
Yeah. Especially in Bangalore and Chennai, where, near the airport side, airport is like 2 hours away from the city. Near airport, there are a lot of construction happening. But before the construction starts beginning, a lot of big developers are coming and buying these plotted lands and, putting in those basic amenities and then flipping that land around. But to buy that land, parcels of 100, 200 CR, it's not that easy. It's not that straightforward. Nobody wants to fund it from their own balance sheet. So either they find partners, which is where, equity kind of holders come into the picture, that, hey, can you give me 2 CR check, 5 CR check? That's the direct checks. So you become a partner in that plotted land development. Either the developer can go to the bank and get a debt. If the developer has good pedigree with the bank and everything. So, or they can also go to private credit funds, like the one you mentioned, Aditya Birla Fund, Real Estate Fund, also did a lot of debt to either construction-based financing or plotted land development. There are certain platforms in the market also right now coming specifically for retail investors who are, asking for 1 lakh or 10 lakh rupee checks, where you can do construction based financing or plotted land purchase and then flip them around, offering close to 18 to 20% IRRs right now
Yeah.
for a 3 to 4 year tenure kind of product, which
Yeah.
is huge and is very appealing
Yeah.
to retail investors, because that roti kapda makan thing is
Yeah.
very imbibed in a normal retail investor in
Yeah.
India.
Yeah. Okay, so we'll talk about the retail bit in more detail, but just to give you guys an indication of the options out there for real estate investment, many of which are actually regulated and there are safeguards put into place. So perhaps the first option that comes to mind is alternate investment funds, or AIFs, which come under SEBI. These can either, in fact, these mostly lend money to builders. Private credit is what it's called, and the rates they get are also quite high.
18 to 22,
Yeah.
20 to 24.
Yep. Um, and because it's a sort of collective vehicle under SEBI, there are rules around taxation which are very clear. So in case of AIF Cat 1 and Cat 2, it's a pass-through taxation, which means that the fund doesn't pay any tax, you pay tax. And Cat 3 where the fund deducts, but Cat 3 doesn't come into the private credit space. So AIFs is the first option. Of course, that has a minimum ticket size of 1 crore, so not everyone can access AIFs. A new emerging asset class in all this is SM REITs, small and medium REITs. Of course, there are regular REITs which have been around for many years, and we discussed that in an earlier episode. But most regular REITs have focused only on commercial property, that to completed projects. SM REITs also have to have completed projects, so it's not like they can go out and buy land or under construction. And a lot of the fractional real estate platforms which were doing under construction now have to get into the regulated zone and stop doing that. But for somebody who wants some kind of exposure to real estate, SM REITs is there. It allows you to take a focused bet on a particular office or a particular mall. Apart from these two, I don't think of, I can't. Oh yes, the third one that you have at your disposal is this new mutual fund asset class above 10 lakhs, where some of them might also do private credit. Of course, those rules are still awaited, so we don't know to what extent they can, but fingers crossed that'll see fruition. So now, Yash, let's turn to the retail platforms and what's going on social media. I know we decided to discuss this last, but let's bring this in now. There are all these Insta ads on all these platforms. So how do you distinguish what is legit, what is not?
It's very, very hard, to be very honest. But the one thing that anyone who sees ads on Instagram or Facebook is, go to the website. If they are a regulated platform, they have to mandatorily mention their SEBI license or RBI license at the bottom of their website.
Yeah.
Which, if you go to most of them, will not be present, because if you are regulated, there are also certain rules around how you can do advertising of your products and your services. So for example, OBPP platforms have a very standardized advertising code.
So OBP means online bond platforms.
Sure. Online bond platform providers have very standardized code. They can't use celebrities, they can't even use any sort of influencer, whereas in all the unregulated ads that you'll see a lot of influencers, even celebrities come up and market these unregulated products right now. So one thing that you should clearly do is go to the website, look at the very bottom in your privacy policy or terms and conditions to find out that registration number. If it's not present there, take a step back and think, okay, what is this product really? What happens if I do invest in and if the deal goes off? But
before we finish this part, just to conclude that with respect to land finance and construction finance, it is still unregulated, right? There are AIFs which participate in this space, but other than that, you can't really do it through a regulated entity.
So if you give a check directly to a real estate developer, that's clearly unregulated unless you can do a contract and then the contractual laws apply. You can go to the court and get
10 साल बैठो court.
तो वो चीजें तो चलती रहेगी, लेकिन there are, if it's a listed, rated, regulated debt that the real estate developer has issued, got it rated from an entity also, like a rating agency, and then listed it on an OBPP platform, then that's fine. That's under the regulatory ambit of SEBI.
Is there such debt coming into the market?
Not right now, no. but I know of certain platforms trying to get that. But for the developers, it's very challenging for them to get their debt rated also and get a favorable rating as well, because the nature of real estate is risky in India, right? So most of the platforms that are doing this are unregulated in nature and do unlisted debt right now.
So, and probably another angle is कि अगर इतना सारा black money मिल रहा है तो why do they need white money from bonds?
I mean, the platforms I have spoken to are very conscious of the black money angle, and they try and only work with developers where that angle is really, really not involved. But I can't rule it out completely. Yes, it exists in India, but to what extent, I am not really aware.
Okay. The other thing that we're going to be talking about is SEBI has come out with a bunch of rules on liquidity for bonds.
Yeah.
So just to break this down, direct investing bonds has one huge problem, which is liquidity. That when you go to sell, nobody is there to buy. Unlike an FD, when you can just break it, sign a FD receipt, and that's done. Or even a debt fund, right? You put a redemption order, your money is there in your account next day. And how has SEBI proposed to solve this, Yash? Can you give us a sort of first standard wala breakdown?
Sure. So before coming to the solution, we also ran a couple of polls in the alt investor community that why are people not getting into a regulated product such as corporate bonds? And the response we got was around 45% people preferred liquidity. They just like the idea of having liquidity, even if they don't want to, immediately liquidate or trade it in the next day. They like the idea of
option
चाहिए कि कभी भी मेरे घर में कुछ भी हो गया गलती से, I want that money back. So option of liquidity never existed before in the debt market. Some platforms were offering come back to us, we'll give you a quote and we'll help you give that liquidity, but it was not standardized. With this new paper that was just released on 16th of October, SEBI has proposed that the issuer, which is a company that is issuing the debt, can give an option of liquidity embedded within the option. Within the bond, that option can only start after 1 year of the issuance.
Right.
So if I issue today in October 2025 onwards, I can start issuing that, give that liquidity option either on a monthly basis or on a quarterly basis.
मतलब हर महीने 1 से 5 तारीख तक they will say you can sell it back to us.
Correct.
Okay.
And the selling price for that will be defined by the valuation on a T-1 basis. So if the liquidity date is, let's say, 6th of October, 5th of October, whatever was the price, minus 1% plus any accrued interest on that.
Oh, minus 1%.
Minus
so
there's
1%. A penalty.
Yeah, there's a penalty. Minus 1% plus any accrued interest on that bond, whatever was pending. You can sell that back to the issuer.
So Yash, if this guy has bought this bond at a 10% yield and now he's selling it back to the company at a 13% yield, then the market price has gone down, so he's facing a loss.
Yeah, so that's the reality and that can happen in the bond market. But SEBI, via this paper, is trying to solve for the liquidity challenge at least. That's their intention. It can very well happen the opposite way as well. The debt was issued at BBB+, the company did well, rating upgraded to A+, and people might make money as well.
So it's not like every issuer will do this, they just have the option to do
it's a voluntary option. But I'll tell you why the issuer might want to do this. One is they get better debt management facility for themselves. They don't have to wait till the whole tenure of debt to finish. If certain people want to buy it back and they want to reduce their debt liability, they can very well do that.
But they can't force the bondholder.
They can't force. It's a put option on the issuer. So for the retail investor, put options means the right to sell exists with the purchaser, not with the issuer. Okay. Another reason that the issuer might want to do this is better pricing. If an option of liquidity exists, investors might be more favorable to adjust to a lower yield on that bond than and a bond with a higher with no rating and a higher yield. Okay. Third is the issuer can buy back the security and immediately sell it back as well at the current yield. So they will make 1% at least on that, which might be additional revenue on their books of finance.
This is a bit mind-blowing. It's like the company is making money on its own bonds.
Yeah.
Well, you don't hear of stock market companies making money on their own stock.
Yeah.
But anyway, be that as it may.
And SEBI has tried to put some guardrails around it in the sense that you can't, not a lot of retail investors can go and say, oh, hey, I need liquidity. Like not all of them can together go and say, I need liquidity. There are rules around it. The definition of retail investors as per SEBI is if the face value of overall bonds that you hold is less than 2 lakh rupees. 2 lakh or less than 2 lakh.
Face value.
Not the face value, but in totality, whatever bonds you hold for that issuer, for that ISIN, needs to be less than 2 lakh rupees.
So you can have 2 lakh worth of bonds with 100 issuers and be super rich, but you'll still pass the SEBI definition for that issuer.
Correct. As a retail investor.
Okay.
Yeah. Because the definition it as an ISIN level
Okay.
for that particular security.
Okay.
So the issuer also has the option whether they only want to give the liquidity facility to just retail investors or institutional,
Okay.
which is greater than 2 lakh as per SEBI definition. So the issuer might just want to do it for retail at the very start. So it's an evolving regulation right now, but definitely boosts confidence in the corporate bond market because liquidity is the need of the hour. Every asset class, even fixed deposits, have liquidity, on-demand liquidity with a haircut. So why not corporate debt?
Yeah.
So it solves for that.
Yeah. And hopefully at some point we might have that in government bonds as well.
Government bonds actually, to be very honest
Already
with you, are
have
fairly
liquid.
liquid. I mean, because institutional players are very active in the government bond market. So, if you try and sell it, you will
Not a
have a
big
quote
challenge.
at least. Yeah.
Okay. All right, folks. Hopefully, we've simplified these two very interesting topics for you. Number one, real estate investment. Number two, corporate bonds and what SEBI is doing to make that more attractive. Yash, thank you so much for shedding light on these incredibly complicated things. Great having you.
Thank you for having me. Thank you.